Hi guys, so in today's video I wanted to take you through my top 3 individual stock holdings. Obviously I hold multiple portfolios, so it's not always clear where the majority of my money actually is, and I thought this would be a hopefully interesting video for some of you. Obviously please remember I am not a financial advisor, so this video is just my opinion and the stocks that I want to invest in, so make sure you do your own research. The other thing to mention is that I am not including ETFs in this video. This is going to be the individual stocks only, and as I've mentioned previous times, I do want the majority of my investments to be in ETFs, so don't take this as me saying that I want to spend the majority of my life having the majority of my investments in these 3 companies, because the majority of my investments will be in ETFs. The final thing to mention is that these actually all have fairly similar amounts invested in them, so it's not like one is hugely outweighing the other in my top 3. So just to be clear, these are all relatively similar weighting within my investment. Okay, so now that that's out of the way, let's just get straight in. So the first out of my top 3 is Johnson & Johnson. I don't think that will come as a surprise to those of you who watch my videos already, but Johnson & Johnson is one that I tend to add to all the time at the moment because I feel like it's currently sort of slightly undervalued. So let's have a look into Johnson & Johnson. Johnson & Johnson has a 2.6% dividend yield at the moment, and it has consistently increased its dividends for 56 years. That's a long time to increase your dividends. But for me, it's not just about the dividend increases as such, although that really helps. It's about the fact that they've paid a consistent dividend for a really long time, which means that this is a stable dividend company in my opinion. And although the yield might not be really high, it is a really decent dividend in my opinion. The company has also been around for 134 years, which means that the likelihood of it going down is probably smaller, although obviously with everything that's happening at the moment, nothing is guaranteed, but they do have 250 subsidiary companies, which in my opinion makes it a really well diversified company and therefore a slightly safer investment. I've also used the company in one way or another from when I was a little kid, so you know, like the Johnson's baby products and stuff. So I firmly believe in investing in companies that you use and know. So, you know, things like where I've previously said I invested in Greggs because I use them pretty much every day since they released the vegan sausage roll. Obviously that was before everything happened in the world. But I do believe in investing in companies that you use yourself and you know other people who use them. If we quickly look at the Simply Wall Street of Johnson & Johnson, you can see here that in the executive summary, they are saying that it is currently thought to be undervalued at 36%, which is partly what I said about I've been adding to them whenever I top up, because they are considered to be undervalued, and like I said, for all the other reasons, I do think that they are a good, stable dividend company, and you know, their earnings are forecast to grow every year. I do believe that Simply Wall Street are saying that it's not as fast as like other companies or the US stock market and stuff like that, but that doesn't bother me as much personally. I just think that as long as the company is growing with a pretty decent rate and they're paying stable dividends and increasing them, I'm not too worried if the growth forecast is low. I'm more worried about the dividends. You can see here in terms of risk analysis, the only risk at the moment seems to be the debt. They do have a high debt to equity ratio and just generally a really large level of debt. However, their debt is well covered by their operating cash flow. So again, not too worried yet. Finally, in terms of their financial health, they do seem to be doing okay. Their assets outstrip their liabilities, which is again partly why I'm not too bothered about their level of debt. And although it says here that the short-term assets don't outstrip their long-term liabilities, their long-term assets do, which to me personally is a safe enough position that I'm content with the debt levels. The next biggest holding for me is Realty Income. If you're a dividend investor, then you'll know all about Realty Income. They are a monthly dividend paying company. They have a 4.7% dividend yield, which is really high, but because they're a REIT, that is pretty standard for a REIT, because REITs, as you probably know, have to pay 90% of their profits out as dividends. Realty have been regularly increasing their dividend since 1994. That's 2 years after I was born. That is a really, really long history of dividend increases, which in my eyes makes it a stable and reliable dividend company. As I mentioned, they are a REIT, which means that not only they are diversified within themselves, they also diversify my portfolio, because at the moment they are the only sort of property company that I hold. I will change that eventually, but they are essentially diversifying away from like the consumer products and into property. If you've watched some of my previous videos, you know that I've had some reservations about Realty before. Mostly it's been around sort of the current situation and their ability to recover rents and how commercial rents are doing in the current climate. But firstly, when you look at their top customers, you've got people like Walgreens, 7-Eleven, FedEx, Sainsbury's, you know, these huge companies, which to me, I think they're not ones to worry about as such in the current state of the world. Obviously, nothing is guaranteed, but that put my mind at ease a little bit. The other thing is that they did recover over 90% of their rents due in the month of November, which is pretty decent in my opinion. So my worry about them has decreased significantly, and I have been adding to my position with them as well. You're probably also aware that I am trying to sort of build a monthly payout portfolio. Obviously, I don't choose stocks purely based on when they pay out their dividends, but Realty was an easy one because they pay out every single month, and that just works well for me for when I'm sort of reaching my financial independence. Again, if we look at Simply Wall Street for Realty Income, it is thought to be 40% undervalued at the moment, which is a significant amount, so that's great. They are forecast to grow about 13% a year. And again, their financial health looks pretty stable in terms of their assets covering their liabilities, sort of similar to Johnson & Johnson. Again, they've got a debt situation going on, but if you look at the history, they've had that debt to equity ratio for a long time, and in my opinion, because they are a company that deals with sort of buildings and things like that, they probably have a hell of a lot of mortgages and debts when it comes to those buildings. So again, not too much of a red flag for me, so I do have this as one of my main positions. They also have a portfolio of over 2,500 properties, if I remember correctly, which is a really well diversified portfolio on their part. And finally, my third top position in my individual stocks is Unilever. They have a 3.4% dividend yield, and they have consistently paid a dividend for 30 years. And whilst they haven't consistently increased their dividend for 30 years, it has been stable and generally on the trend up. So some years it's been decreased, but it's gone back up very quickly. Again, to me, that's a big deal because they are a fairly decent dividend and a really stable and reliable one too. Unlike the other two, they are also a British company, which means I eliminate the forex risks and stuff that come with investing in US stocks. They were found 91 years ago, which again, in my opinion, makes them a fairly stable and reliable company. And in terms of their products, they are insanely well diversified. They have products like food, candy, cheese, soft drinks, cleaning agents, coffee, pet food, bottled water, toothpaste, frozen pizza, beauty products, personal care, pharmaceuticals, and healthcare products. They own over 400 brands, which is just mind-blowing. That again to me means they are extremely well diversified in their products, which makes them a really reliable company. So again, if we look at the Simply Wall Street analysis here, they are considered to be undervalued at the moment, only 8.8%, but still undervalued. Their earnings are forecast to grow and they pay a very reliable dividend. In terms of the risks, you can see here, again, high level of debt and lower profit margins than last year. This doesn't concern me because I'm pretty sure most companies have lower profit margins this year than last year. Whilst Unilever has a really high level of debt, this is an insanely high debt to equity ratio. Their debt is well covered by their operating cash flow, and They have made a pretty good use of their debt before to make returns to shareholders. This year, I believe they've acquired some healthy nutrition companies in India. Actually, let's have a look. So this is from their 2020 first half announcement. During the second quarter, we completed the acquisition of the health food drinks portfolio of GSK in India, Bangladesh, and 20 other predominantly Asian markets. Acquiring the iconic brands Horlicks and Boost is in line with Unilever's strategy to enhance its presence in healthy nutrition, which I fully support. And from my online research, it does seem like Unilever managed their debt pretty well. Obviously, it's something to keep an eye on, but at the moment, it's not really something of a major concern to me. Hopefully that's been a useful video. Let me know if you want more videos like this or not. I will adjust. But for now, that is it, and I will see you in my next video. Bye for now.